basically the economy is stagnating. Most of the major economies basically are running budget deficits. And that, of course, is the source of growth in GDP. It's not productive. So this also conceals what's going on in the under. We are in a sort of rolling recession type thing, which is not really reflected in the headlines. And in the case of America, the statistics are no guide at all to what's going on. Not that they ever.
Hello and welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the JR Mining guy over on Twitter, CEO of the Soar Financial Group, and of course, your host for this conversation today. And I'm joined by recurring guest, a longtime friend of the channel, Alistair McLeod. He's the head of research over at Gold Money, but he's also now publisher over on Substack, and really looking forward to hearing what he's been up to the last 6 months. And of course, we're going to recap some of his calls that he's made. As you might remember, we had him on last December 24th, which is our German Christmas holiday here. So it was our Christmas special, and now we're going to recap Q1, Q2, and the first half of the year. Lots to talk about: geopolitics, economy, but also gold price developments. So stay tuned. It's going to be a phenomenal episode. I'm pretty sure of it, although we're just starting to record it. So, but I know it's going to be a good one. Before I switch over to my guest, hit that like and subscribe button. It helps us out tremendously. Leave your comments down below. What do you think is happening? And are we asking the right questions? What should we have asked, or what should we be asking? So let us know. Alistair, welcome back on the program. It is good to see you again.
Hello, Kai. Nice to see you.
Yeah, we got lots to talk about. We just briefly chatted about it. We got content for about 2-3 hours here, easily lined up, but we try to squeeze it into about 45 minutes to keep it, palpable here. Yeah. Instead of asking my usual question of how the economy is doing and the world economy is doing, let's start with how was it doing the last 6 months, and are you surprised at where we're at right now?
I'm not surprised. Basically, the economy is stagnating. I'm talking about the economies of the Western Alliance, let's put it that way. We'll keep the Asian bit separate from that. But I think this idea that, GDP is growing and all the rest of it has been very much down to the extra currency injected into the economy, currency credit, by central banks. And most of the major economies basically are running budget deficits. And that, of course, is the source of growth in GDP. It's not productive. So this also conceals what's going on in the underlying economy, so that, this is at odds, if you like, with, if you go and talk to businesses up and down, say, Germany, Britain, Australia, the US, you will find the answer is all the same. It's damn tough trading. And, they're not really employing anyone. We are in a sort of rolling recession type thing, which is not really reflected in the headlines. And in the case of America, the statistics are no guide at all to what's going on. Not that they ever really are. With statistics, you can tell anything other than the truth. But that's certainly true, I'm afraid, with American employment numbers, which seem to be just made up out of thin air.
Good point. Like, U.S. challenges is one of the predictions you made, that the U.S. economy will face massive challenges, and 4% unemployment rate. I was in South Carolina 10 days ago, and to maybe personal anecdote, and I went to a Ruth's Chris Steakhouse on a Friday night in Myrtle Beach, which you would think, okay, this is one of the hot spots. It's where a lot of people go to golf, especially in June, perfect time of the year. Friday night, the place was 30% full. So, and that's one of the restaurants where I think, okay, on a Friday night, it should be packed, right? It was 30% full. And while we're eating around 8:30, 8 o'clock, 8:30, it emptied out, right?
Yeah, and of course, Kai, the origin of that is that people can't afford really to eat out so often. I think that's a sign of the stress in the economy.
Yeah, that's exactly what I was referring to. Is like, and then maybe on the other end, and that's what really threw me off here. We drove down to Jekyll Island. We stayed at a place on the beach, and we had a room facing the island. While others, and maybe a couple we met there, I wouldn't put them in the highest bracket there. It's like just based on appearance, right? Don't get me wrong. But they were ocean views. They had the room with the ocean view, which is like a $450 a night room. And it's sort of like I was trying to figure that one out, the disparity between the Ruth's Chris experience and then the Jekyll Island experience. I was just intrigued, like the bifurcated picture of the economy is like, help me make sense of that, Alistair. Like maybe you can help me explain that one.
I think it's the old story. It's the difference between Main Street and Wall Street. I mean, financial assets are still high in value, which basically means that those who have, stocks, shares, 401ks, whatever, are in a reasonable position. But, those guys who actually go out and make things or provide services for a living, they're the guys who are struggling. And I think that's, Jekyll Island. Jekyll is incidentally the original pronunciation. I know everybody calls it Jekyll. But, Jekyll Island, is such a place in US monetary history. It's really where everything started to go wrong. So I'm sure it's visited by lots of people who sort of, they sort of pray at the altar of the Fed, sort of thing. Anyway.
No, it was an interesting thing because I was trying to observe what is happening. And the other thing I noticed in the U.S. gas, like I paid $2.78 a gallon at one point.
Yeah.
In South Carolina, which was way down from where it used to be. I remember taking an RV trip. I think it was in 2022, and we paid about $5.50 a gallon.
Ooh, yeah.
Right. So massive decline, and so I'm trying to put that into context. Like I'm observing and trying to figure out, okay, what am I seeing here? So inflation is being kept artificially low, maybe by keeping gas prices lower, because I've seen the SPR being drained again, and Biden wanting to empty it again, or release some of it, not empty it, but release some of it. Because it all speaks to like the economic turmoil that you've predicted for the year, and I haven't seen it yet. I think we're still like cruising along. There's not really any bumps in the road. We only see small indicators, like you mentioned, the U.S. employment numbers tick up a little bit, but no turmoil yet. When do you expect doo-doo to hit the fan there, Alistair?
That's, it could happen any time. I mean, to my way of thinking, we've got mounting risks, particularly on the conflict between the West and the Asian hegemons. I mean, only this week, we have seen US missiles being used by the Ukrainians to, on the beach in, I don't know, Crimea somewhere. And those missiles could only have been American, and they can only have been guided by American satellite technology. So this has definitely upset the Russians. We have seen Putin go to North Korea, and I saw an interview with Dugin, the sort of senior Russian philosopher, and he was saying that what's come out of that trip and the trip to Vietnam and all the rest of it is a hardening of determination on the Russian side to turn their backs on the West and no longer pussyfoot around, if you like. I'm paraphrasing. So that's not good. We're also seeing an American aircraft carrier and its attendant fleet going towards Israel, presumably to counteract the threat from Hezbollah. So that looks like potentially blowing up. I mean, it's the sort of situation, Kai, where, if you sort of continue with a bullish view on the economy, or on stocks, on bonds, whatever, on the dollar, you could suddenly find that the whole thing gets undermined very, very quickly. And for those who, like us, understand that gold is actually the only way out of this credit risk, then, to sit in your hands and sort of say, well, I think it might come back a little bit. Well, it may well do. But I think you won't forgive yourself if these events start to come through quite rapidly and you haven't bought. So that I think is roughly where we are. There's a lot of risk out there, and that's not even the economic risk. I mean, the economic risk is still there, as we've just discussed. And on top of that, everybody expects interest rates to fall. If they do fall, they'll be manipulated down because when you get a contraction of credit, which is actually what's happening with the over-leveraged banking system, then the cost of credit, interest rates, rises actually. So, and also you've got the U.S. economy is, or the U.S. government rather, is definitely in a debt trap. So you are going to see higher bond yields along the yield curve. And so the Fed actually isn't in control of interest rates any more than anyone else is. And I think another thing which we should know is that the only funding now that I think the Fed is doing is really as a result of the carry trade out of the yen. I mean, the money funds and the banks, I think, have put their liquidity into T-bills. And now it's up to hedge funds and others, to short the yen, take the proceeds and go and buy US treasuries with it. Because for the yield pickup, I mean, and you see the yen fall and all the rest of it. So that is vulnerable to a sudden bear squeeze, if you like, on these guys in the yen, which could come out of nowhere. I know it seems unlikely, but there are all these dangers. So I think these summer months, where in this country we sort of forget about stock markets, we go to Wimbledon instead. There's all these sort of sporting events that we have in the summer. And we tend not to worry too much about stocks and shares and whatever. I mean, I think that, I can understand that attitude and I agree with that attitude, but don't leave for Wimbledon before you protect yourself against what might happen when your back is turned. So I can't tell you when all this is going to go. As you put it, the doodah hits the fan. But there is a significant and growing risk that it could happen at any moment.
Yeah, let's stay on the macro there, Alistair, because I want to talk gold, obviously, and there's lots going on in the gold space that we need to talk about and address, especially central bank buying and the violence of the gold price move. But back in December, you mentioned that you didn't expect any Fed rate cuts anytime soon, and so far we're sitting here at the end of June. It doesn't look like there will be any. Maybe in September we'll see one if we, the market predicts it correctly. But so far the market has been way off on it anyway. The market predicted up to 7 this year. We're down to 1 now. Let's talk to that. As the U.S. economy still seems to be stable enough that the market and the Fed seems confident to keep the rates where they are. No rate cuts. QT has been loosened a little bit. We see a bit more, although quantitative tightening is still going on. I really want to paint that picture. Like when you're looking at the Western economies, and we do have to highlight the U.S., what are you paying attention to exactly there? And how is that going to continue?
Well, the problem the Fed has on interest rates is that it's got to fund the US government's debt, or it's got to run a monetary policy which is consistent with that. And I think that any sign that it's going to start reducing interest rates, and you'll find that it just makes that more difficult. I mean, as I said, I think that the carry trade out of the yen is getting more and more important. The Bank of Japan is being forced extremely reluctantly to raise rates. And I have no doubt at all that the Fed is talking to the Bank of Japan and saying, I think, you don't need to raise rates. Keep them low, old boy. Because what they want this, they're becoming dependent on this carry trade, I think, to finance US government debt, because the foreigners, I mean, China's not buying. The Japanese institutions aren't buying, that is for sure. I mean, there may be some still doing a carry trade, but I think as far as the carry trade is concerned, I think it's mainly US interests which are shorting the yen in order to buy US treasuries. It's T-bills rather than anything. I mean, this is all very short-term stuff. So I think that is one reason, and a very important reason, why the Fed is delaying on the cut in interest rates. And as I say, we have this situation where the banks are over leveraged. And I mean, just listen to Jamie Dimon. He's made it quite clear that he doesn't want to expand his balance sheet leverage anymore. If anything, he wants to reduce it. So, JP Morgan can't reduce its balance sheet as such. What it can do, well, I mean, it might be able to on the margin, but it would be catastrophic for the US banking system. All they can do is move out of risk. And so, they basically what they've done is they've gone out and they've bought US T-bills 3-6 months, probably at a stretch even 12 months, but I think probably mainly 3 and 6 months. So the funding of this deficit is a rolling problem, as it were, which is only getting worse because it's the average duration of US government debt is declining and declining and declining, and that's a very dangerous situation. But the Japanese institutions, of course, are looking like turning sellers. You had this central bank for the farmers and fishermen declaring that they had made enormous losses on their foreign bonds and all the rest of it. It's interesting because the losses aren't on the currency. The losses, I mean, we don't know whether they hedge the currency or whatever. I doubt it, but they've got the losses on the bonds. So, I think that virtually every bank in Japan, and also the insurance companies and pension funds, if they leave anything in US dollars, it's going to be very, very short term. So this is not something that leads to the wholesale selling of dollars, but if the Fed starts reducing interest rates, then I think it's going to make its funding problems a lot more difficult. So other central banks like the ECB don't feel that sort of pressure because they're not responsible to any one government. So I think that's the fundamental difference, if you like, between the two.
Yeah. No, I appreciate that. I appreciate the explanation there, Alistair. And Japan, I think, holds $1.1 trillion of U.S. bonds last time I checked. So, and they're the biggest lender, I believe, to the U.S.
Well, yes. I mean, the difference between them and number two, which of course is China, is that virtually all the ownership of U.S. treasuries in Chinese hands are in U.S. government. The Chinese government or its central bank. So, that's, say you've got one single investor who has decided some time ago to start reducing its position, and of course that's entirely consistent with de-dollarization. Japan is fundamentally different. The Fed or the US Treasury can't go to the Japanese government and say, can we cooperate on this problem? Because it's not the government there that owns all these Treasury, notes, bills, whatever. So there is this fundamental difference. The Japanese situation is not controllable as far as the US is concerned, other than the bribery of keeping interest rates up.
Yeah, there was just some news this morning. I was just reading on Reuters, Alistair, that the Japanese might actually increase QT more than expected and raise rates again as well. So that could be an interesting trigger out of bonds and to maybe help bring the system down, I guess. Is that something you've witnessed as well or observed?
Yeah, I mean, the inflation rate, well, I mean, I don't care about these things particularly because they're all made up anyway, but the inflation rate in Japan appears to be higher than 2%. So, I think in terms of the logic of, managing interest rates to control the rate of inflation, which is actually a complete no-no, it's all mythology. It's just smoke and mirrors and a waste of time. I mean, I think we've just got to look at what's happening to the sort of funds, as it were, which is why I would insist that, from the Fed's point of view, they don't want to see the Bank of Japan raising interest rates. I mean, perhaps on a small margin, maybe. They would rather that, US hedge funds and others could continue to short yen in order to buy dollars to buy treasuries or T-bills. So, and I think that's what's driving the whole thing at the moment. I don't think we need to look much further.
Yeah, it looks like that carry trade, that arbitrage, that spread gets smaller as well because the 10-year is at 4.25 right now. So that is shrinking because the yield is coming down surprisingly. Seems like there is a bit of a rush into that market.
Yeah, but I think looking at the yields along the yield curve, I don't expect it to remain a negative yield curve for very long. I think as the funding crisis becomes more and more obvious, you're going to see those yields along the yield curve rise. So we can say that, I think, irrespective of Fed interest rate policy, because it's driven by supply and demand. And the supply and demand is driven by foreign supply and demand. And this is the key thing. And if the foreigners aren't buying, if the foreigners continue to sell, I think that even domestic institutions, other than the pension funds and insurance companies who feel obligated to put X percentage of their income, as it were, into US treasuries. Other than that, I think you'll find that there are sellers. Other foreign holders, I think, equally will be less keen to buy US Treasury debt out along the yield curve. And I mean, the fact is that the US Treasury is in a debt trap. With debt increasing by a trillion every less than 100 days. I actually think that the budget deficit is still being underestimated by the Congressional Budget Office, which recently revised its figures. My personal expectation is it will be over 3 trillion in the current year to September. Whether it's that high or not is actually not that material. The fact of the matter is they're in a debt trap.
Do you see signals of a funding crisis already? I find it quite interesting, and I think we talked about that as well. I just typed into Google U.S. government bond issuance and to the news section, and you can't find barely any coherent articles about U.S. government bond issuance. It's like it's mind-blowing to me. So
absolutely. I mean, this is the extraordinary thing. I mean, this is obvious, absolutely obvious for anyone who looks at the numbers, but nobody seems to be talking about it.
It's puzzling. I just typed it in U.S. government bond issuance demand, and there's maybe an article from a week ago, then October 2023. Like, there's nothing really like being reported on that matter, and I think it is vital. That's why I'm asking, like, do you see signals of a funding crisis right now?
Well, yeah. I mean, Kai, it's not just U.S. treasuries. I mean, all markets are living in fairyland. I mean, look at the situation in the UK. We're about to get, I mean, it's almost dead certain, we're about to get a highly socialistic government, which is going to be less successful at containing the budget deficit than the current conservative lot, if you like. This, I think, is going to scare the foreigners out of sterling. I mean, it's bound to. So I can see sterling falling to test the lows that we saw back in 22, I think it was, when it got down to $1.08. And we're currently, 126.5, 127, something like that. So, and I actually think that it's going to challenge the 1-to-1, parity against the dollar. That's a 26.5% fall in sterling. So, what should you be doing as a UK resident? Well, you should be buying gold sovereigns because you're going to get a 27% lift, even if nothing happens to the gold price. We're seeing the yield on UK gilts being less than the yield on US treasuries. Now, we know that US treasuries are not the best thing in the world, but it's meant to be. Sort of, if you like, the credit reference, the zero risk credit reference. I mean, so why gilts yielding less? I mean, why, for that matter, are French oats yielding less? You can see that markets are just completely screwed, and at some stage they're going to snap into reality. And going back to what we were talking about earlier, this could happen at any moment. Probably when you're watching Wimbledon.
Probably. Ellisers, I think we have been talking about that as well. $2,000 US per ounce of gold was always one of those magical hurdles that we had to jump over. But also we talked about what does the world look like when we are at $2,000 gold? There were predictions, while the US won't be able to repay any debt, it just means that the world is in a world of hurt financially and that there's massive trouble on the horizon or even happening already. We're not seeing it. We're at about $2,400 gold an ounce. Yet, if you look back now, what should be the implication of a high gold price or the high gold price environment that we're in right now? If you were to look back at it, it's we usually talk about this is causing a higher gold price, but let's look at $2,400 gold and say, okay, what is this causing?
Well, I think there's a misunderstanding about what $2,400 gold price really means. I mean, we can illustrate this with the actions of the People's Bank of China. Read all the headlines. The People's Bank of China has been buying gold. That's actually got it completely the wrong way around. What the People's Bank of China has been doing is selling dollars. And the distinction is terribly important, Kai. Understand the distinction, and you'll understand actually what's happening. Because what the People's Bank of China is in effect saying is, we think the purchasing power of dollars in our reserves is going down. Now, there are various reasons why that might be the case, but it is the purchasing power of the dollar falling, not the price of gold rising. And this is where everybody gets gold wrong, and particularly the establishment, if I could, the bullion banks in London, the swaps on COMEX, all these guys, their only experience has been in a fiat currency environment since particularly the mid-1980s, when everything was financialized with Big Bang in London and so on and so forth. So what they're doing is they're trading something. They account in dollars, or they account in euros or pounds or whatever. So their comparison is profits and losses measured in the fiat currencies. But actually, in monetary terms, because gold is legal money without counterparty risk everywhere, and euro and mine currency are not counterparty risk free, and they're not used everywhere, you can see where the risk is. The risk is in the fiat currencies. So, on that basis, what we're seeing with People's Bank of China and also all the other central banks who are doing exactly the same thing is they're sending a very clear signal that they're seeing the purchasing power of fiat currencies declining. So where do you get out? I mean, do you sell dollars for, I don't know, yen? Well, we've just knocked that argument on the head. Euros? No. I mean, the answer, Kai, is that the dollar is the king rat of currencies. It is the number one fiat currency. And if you're going to get out of the dollar, you've got to get out of fiat currencies, full stop. And you've got to go into gold. And this is the conclusion that central banks around the world have woken up to. And of course, this also doesn't augur well for US debt funding from foreign sources.
Maybe sort of expecting or knowing the answer here now is like, but were you surprised by the violence of the move, like the fast pace of how quickly gold moved up to $2,400? And maybe as part B of that question, like, why did the engine lose steam here, and why didn't we plow ahead to maybe $3,000 gold? I'm exaggerating potentially here, but why did we run out of steam?
Well, I mean, if you look at the charts, this is what everybody does when they don't understand what's going on. Look at the charts, and you can see there's been a long consolidation period, so the breakout was bound to be, pretty dramatic. Dramatic initially, and again, talking purely in charting terms, it's the start of a new bull phase. So that's where we are. I think what we've seen sort of part one of the new bull phase, that was a run up to 24.45 or whatever it got to. We're now consolidating that, and we've been consolidating that for the last 2 months or so, 2 or 3 months. And at some stage, that consolidation will end, and off we go. But as I say, what it's actually about is the declining purchasing power of the dollar, which we're talking about when we look at the gold price, or if you like, the dollar priced in gold, that's going to continue to decline. I mean, what gives the dollar its value? I mean, we're talking about bits of paper or units on in some sort of electronic account. It's just faith in it. It's just faith. That's all it is. What gives gold its value? Well, you can actually hold it, and it's legal money. This is the point. I remember when we were, when you very kindly invited me to talk in Frankfurt, I made this point to the invited audience, and I don't think people understand this point enough. So gold will continue to appear to rise, but actually what's happening is that its fiat currency is falling. But there is another element to this now, and that is that I think the understanding of this is going to widen, and particularly amongst Chinese savers. The point is that the Chinese, as a nation, are a saving nation. It's estimated that Chinese households save 35% of their income. Now, 35% of their income is around about $6 trillion on Chinese GDP. So $6 trillion, where does it go? Property, yesterday's story. Stock market, not really. It goes into bank accounts and it goes into gold. And I think it's increasingly going to go into gold and also silver, because Chinese individuals can't go and buy foreign currencies or foreign stocks or anything like that. They don't have these avenues which we have become accustomed to. Whether the avenues are good or bad, it's a secondary question. But as far as the Chinese individuals are concerned, their banks will offer them the facility to deposit money, currency, yuan, in yuan accounts, or alternatively in gold accounts. And as long as you've got a minimum of about 500 or 600 yuan, which is about $80 or something, you can open a gold account and you can accumulate your savings into that. What does the bank do? Well, the bank has to go out and cover these liabilities. Now, it might do it on a fractional reserve basis. I don't know, but I doubt very much that that's going to be the case. I think they will try and back it with physical bullion as much as possible. Of course, we don't see this necessarily because the accumulation of gold reserves, say that any of the major Chinese banks, will be in the Shanghai Gold Exchange vaults. So this isn't going to be delivered to the public, which incidentally has already delivered something like 27,000 tons of gold into the public. So, this is gold. This is why gold is moving. The pricing of gold has actually moved to Shanghai. We're just dealing in sort of paper, which pretends to be the real thing. But it's not. It's not. So these are interesting times, if I can say that. As the Chinese would say, live in interesting times.
Yeah, very interesting times, because a couple of weeks ago we had Super Friday for the gold price, but in a negative terms. Like maybe I'm not sure. We need to come up with a better term for it. But we had the jobs report, but then another news release came out that the People's Bank of China didn't buy any gold in May, and that really pulled the rug under the gold price for a bit. And I've just got a couple of headlines here. Gold is so expensive that even China's central bank stopped buying. Right, that doesn't sound like a very logical headline, to be quite honest, understanding what we discussed and where things are potentially headed here. But let's dive a little deeper. Do you believe the announcement? Does that make sense? And why would they stop buying now all of a sudden? What's the logic behind that?
Do you really believe they've stopped buying it?
I've
got no idea. We actually don't know what they've got. We can only go on what they say. And we all know governments lie through their teeth. So why should we start believing the People's Bank of China? The fact of the matter is that, and this is fact, long before the Chinese people were allowed by the government to accumulate physical gold, the People's Bank of China was accumulating gold for the state, and it was siphoning this off into various state accounts to hide the degree of gold accumulation. They were appointed to do this by law, and I've got an English copy of this law, back in 1983. And it wasn't until 2002 that they suddenly turned around and said, okay, we'll let the people buy gold, and we will set up the Shanghai Gold Exchange, which is controlled by the People's Bank, incidentally, in order to facilitate them to do this. And then they started advertising to people, rush out and buy gold. This was the Chinese government advertising, the merits of owning gold and all the rest of it. So, the state, I reckon that by the time 2002 arrived, and remember, we're looking at a market which was a bear market in gold. Gold was being, if you like, rejected by the Western capitalist fiat money system, so much so that it went down to, around about $250, from sort of, a very brief peak at over $800. And it was during that massive bear market, when everybody in the West was getting rid of gold, that China was quietly sort of buying it in. They were the hidden buyer of gold. And they've accumulated it. I reckon that by then they'd probably accumulated something like 20,000 tons at contemporary prices. you know, it just made an awful lot of sense because, China wasn't exposed to Keynesian economics. And therefore, they understood that gold is true money. And I understand that even in Mandarin, the word for gold is the same word as for money. So, we know what they're, how they see this thing. So, what do you do when you're, getting all this foreign inward investment in the sort of 80s and going into the 90s, and then your huge export earnings, and you're controlling the entire foreign exchange situation because you're not allowing ordinary Chinese people to go out and buy foreign currencies for whatever reason. But given that that is the case, what do? You take those flows and you look at something like, well, it makes sense to put something like 10, 15% of those flows into gold, and that gives you somewhere between 20 and 30,000 tons at contemporary prices. Now, they won't have stopped there, of course. I'm sure that they've continued to accumulate gold from time to time. We don't know whether the accumulation that the People's Bank of China has been reporting until it appeared to have stopped has been drawing down on its existing stocks, which it bought back in the late 80s, early 90s. Or, we just don't know. It's just a book entry. That's all it is. So, but what we do know, and I think this is the point which everybody should understand, is that China is a savings-driven economy. There is absolutely massive, massive quantities of currency which is seeking an investment home. And that is around about 6 trillion a year. And I would have thought that gold and silver would be the most effective hedge for Mrs. Wong or whatever, living in one of those mega cities in China. So, that I think is the real driver. I mean, I forget what the People's Bank is doing. And anyway, as I said, I mean, basically the People's Bank is trying to get rid of dollars, and that's actually what's driving its foreign exchange policy.
Yeah, I think we spoke with Alexander Stahel of burggraben.ch just last week or 10 days ago here on the channel as well, and he made an effort emphasizing that the real estate business in China is dead, that everybody used to invest into concrete gold, and now it's proper gold, precious metal gold, and sort of shifting focus because the real estate sector is imploding in China right now. So people are looking for alternative investment solutions, maybe ideas there as well. So right to your point there. Alistair, since I have you, we do have to talk a little bit alternative currencies and de-dollarization. There's been a few articles and things I've been that popped sort of up on my radar screen. One is Saudi Arabia recently joined a BIS, which is the Bank of International Settlements, and China-led central bank digital currency project, which is really interesting because that project has existed for a while, but now Saudi Arabia joined it as well. Run us a bit through the scenarios that you're seeing right now in terms of de-dollarization, but then, of course, alternative currencies here.
Yeah, I mean, this is an initiative. And basically, the problem I think that traders have is that they've got used to the dollar, if you like, as the trade settlement medium. Internationally, everybody accounts in dollars and all the rest of it. So replacing the dollars is actually quite a logistical headache. The sensible thing to do is obviously, to do this on a gold standard, if you like. But this is a very difficult thing as far as China is concerned. China's problem is that she knows that if, let us say, she does move towards a gold standard, then that's going to undermine the dollar. It'll collapse the dollar, in fact. There's no two ways about it. And China does not have a policy, if you like, of being aggressive in these matters. You'll see that virtually her entire foreign relations policies is, basically let everybody else make the mistakes. We will then defend ourselves from those mistakes, but we will not create problems. So that's the Chinese approach. And I think that really what China's looking at is some sort of alternative to, gold directly. I mean, she knows that she's eventually going to have to go on the gold standard, but in the interim, what she needs to do is to find something else so that she can do a growing portion of her trade not in dollars, and also probably not in her own currency. I think she's, sort of rather wary of losing control of her currency. She doesn't want her currency to become a reserve currency. So I think that's what's driving this situation, and that it's really basically trying to do without currencies. I mean, I had a look at the Bank of International Settlements paper on this, and the one thing I couldn't find was what this, what's it called, Embridge or whatever. What's it backed by? There's no backing mentioned about it at all. Which I think is a huge, great error. If they turned around and said, this is going to be backed by gold, and they do it in a credible way, then I think it would make sense. But at the moment, I think it's probably more in the planning stage than anything else. I don't really. I mean, they may do a few sort of trial settlements or whatever, but. And I think as far as the Saudis are concerned, I mean, China is their largest customer by far. So if China sort of suggests something, they're going to look at it. Of course they are. And, I don't think they've made any commitment, incidentally, to this Embridge thing. I think that they're sort of saying, well, we'll look at it. Yeah, it's interesting. And I think that's about as far as it's got.
Yeah, I'm quite intrigued of the role of the BIS in all of this, because I interviewed Chris Powell the other day. He's Secretary and Treasurer of GATA, like the Gold Antitrust Action Committee there, and he keeps talking on and on about the BIS and how they're involved in the swaps that keep the gold price down as well. So I'm trying to make that connection and try to figure out, okay, what is actually happening behind the scenes here, and what is the motivation of the BIS to establish the Embridge system that you mentioned in comparison, because the US and everybody else is a member of the BIS. Like pretty much all countries are involved there. So it's like I'm trying to figure out what the motivation there is. Are they just an intermediary that really tries to please everybody by looking at all the different opportunities? Or like, do you have an inkling of what the motive of the BIS would be to be involved in a system or creating a system like that?
Yeah, I think the answer is actually quite simple, and that is that the Bank of International Settlements is if you like, the research center for banking evolution or central banking evolution. It hosts central banks representatives on a sort of Chatham House free chat basis every 2 months. So you get the exchange of information, and of course, it's the way in which, a cynic might say, that the Fed and the ECB and all the rest of it ensure that other central banks are thinking on the same page. But the Bank of International Settlements has centralized, particularly all the research in CBDCs, and it is, if you like, the go-to place for what everybody is thinking about doing with CBDCs. The Bank of England, interestingly, produced a white paper. A white paper is, if you like, a sort of proposal, but it's a sort of proposal rather than anything else. And on CBDCs. And interestingly, they didn't go down the Bank of International Settlements route, whereby CBDCs would be seen as a means by which a central bank could control the application of credit in the economy. What the Bank of England proposed was that, a sterling CBDC would be, it would be managed, if you like, through the commercial banking network. Because the problem with the CBDC is that if a central bank is going to issue a CBDC under the Bank of International Settlements proposal, every individual, every business will have to have an account at the central bank, bypassing the commercial banks, in effect. And that is, I mean, the idea, I can tell you in this country, the idea of getting, the software and, the committee stages and all that, I mean, that's a 20-year project, and then it probably wouldn't fly anyway. And I think as far as America is concerned, I don't see her buying this at all. I mean, bear in mind that the commercial banks basically fund all the politicians. Are the commercial banks going to vote for like turkeys for Christmas? I doubt it. I just don't see it. So this is a sort of project, which everybody sort of, all modern thinking people have got to grasp. This is going to change. We're going to have CBDCs and all the rest of it. I think there's an awful lot of hype around it, really. And I put this Enbridge thing sort of in that category. But the one thing I would say, which means it might not be quite in that category, is that the fundamental difference between China and Russia's approach to its economy is that the state runs the affairs. The state takes the basic decisions. They've evolved from communism, which is total control, to allowing individuals to run businesses, to act as entrepreneurs, but always within the guidelines, within the control of the state. So they are perhaps more in tune with the idea of a CBDC, where the government controls credit, than, say, we are in the West. So I think that's a slightly complex answer to your basic question, but I'm not taking the CBDC thing all that seriously. But I would say that I think the situation is, or could be, fundamentally different in Russia and China.
Yeah, I find it interesting because SWIFT also planning to launch a central bank digital currency platform in the next 12 to 24 months here, and SWIFT we all know is being used by 90% of all digital payment transactions here as well. So I'm curious what that really means, but we'll save that discussion for another time, Alistair, because we both have hard cutoffs here today. So really appreciate your time, and of course we can learn more about the CBDCs and the impacts and your thoughts, of course, on your Substack. Is that correct?
Yeah, absolutely. I have a Substack, which is McLeod Finance Substack, or the address is alistairmcleod.substack.com, but not many people will be familiar with the spelling of my name, so just Google McLeod Finance Substack and you'll find it. No, or you might put in a link to this video, which I appreciate very much. The whole point about it, Kai, is that I'm on a mission to educate as many people as possible, and we're not just gold bugs and silver bugs and all the rest of it who would be, let us say, the normal customers of Gold Money, where my stuff is still published. I want to appeal to a wider audience, to people who don't realize the difference between money and credit, and the fact that money is still gold, has been since Roman times. Legally, it's in all our common law, etc., etc. What governments are doing to credit, the future of credit. You've got to understand economics. You've got to understand geopolitics. So I cover all these subjects, and I would encourage anyone. And I mean, interestingly, I don't have a huge number of followers on my Substack in Germany, and this is a nation which has been wiped out twice in the last 100 and something years, 100 years, currency-wise. It's going to happen again, I'm afraid. And it seems a pity that the current generation of Germans just don't seem to be aware of the danger which is being repeated on their grandfathers and great-grandfathers.
Sad but true, Alistair. You're absolutely right there. And we love gold to a degree. We love gold mining stocks, but that's more the older generation, I have to admit. Like when you go to conferences and events, we do see like a few younger investors come to Deutsche Goldmesse, but the ratio is completely out of whack.
Yeah, absolutely. So, and I mean, it's I was at I was speaking at a conference in Zurich in, I think it was April. And again, it was exactly the same thing. Around the continent, it's the old wise heads, who have a bit of a knowledge of history, maybe lived during times before 1971. They're the ones who are a bit more curious about what's going on than the younger folk. I mean, the younger folk, perhaps, you're looking at these conferences, you're looking like at people in the mining industry, mining executives, geologists, that sort of thing, venture capital guys, the M&A business, all that sort of stuff, which is all younger stuff. But I mean, they don't actually understand the monetary side of things. They're just looking at mining businesses from the point of view of profitability. And as far as they're concerned, a higher gold price basically makes a mine more attractive, if you like, assuming that the costs don't rise faster than the gold price. So, this is that's what we see, isn't it, Kai? I mean, it's just the younger generation, I'm afraid, are still asleep on this one.
Now, Alistair, you just wrote our mission statement for the channel. I'll just copy and paste that because that's exactly what we're doing. We're discussing the macro to understand the micro. That's exactly what we're doing. And really appreciate your time, Alistair. Again, I'll copy and paste what you just mentioned. I'll use it as the mission statement for the channel. So really appreciate it. And thank you so much for joining us, Alistair. As always, a huge pleasure. And everybody else, thank you so much for tuning in here to Soar Financial. You just heard from Alistair. Educate yourselves. There's a storm coming, or we're in the middle of it already. Feels like we're in the eye of a hurricane a little bit because last couple of years have been turbulent. It's quieted down a little bit. And let's see what comes on the other side. But educate yourself. Follow us here, follow other informational YouTube channels, get educated. It really helps make better investment decisions. Tremendously appreciate Alistair's time. Did we ask the right questions? Was the content of value? Leave a comment, leave a like. We do want to hear from you so we can create better content. And of course, your subscription helps us bring guests like Alistair onto the channel and bring other great guests on as well. So thank you so much. Really appreciate the support, and we'll be back with lots more here on Soar Financially. Thank you.